It looks like 2023 is going to be a chaotic year. It is so important to focus on not just how we got to this place, but where we are headed. The very first thing I want to look at is the Fed. The Federal Reserve is in a corner right now. I'm going to show you why that's important to you. The second thing is Main Street's problem. What is Main Street facing? The third thing is the geopolitical strain that's taking place between the United States, China, India, Vietnam, Russia, and so much more. You don't want to miss it. Let's begin. BlackRock is calling for a recession in 2023. You know that they have been dealing with their own strain, actually having to pause redemptions on one of their funds. People start pulling out that cash saying, oh my goodness, a real estate crash is happening. I'm going to take my cash. And BlackRock says, no, no, no. This is a quote. Recession is foretold as central banks race to try and tame inflation. People don't like being told there's a recession. People don't want to hear about that. They want to know, which stock do I buy today to be rich? And unfortunately, we have to look at the truth. This is just the way it goes. You invest based on the information that you hear and you get, and you don't just take somebody's word for it. You want to know it all. This is just what we're living through as the Federal Reserve goes through their cycle. I will talk more about that in just a second. In fact, the strategists believe that the central banks are, quote, deliberately causing recessions by what they consider over-tightening policy in an effort to bring price levels under control. You see, BlackRock doesn't care if lettuce goes from $2 to $5 or you're suddenly spending much more money to heat your home. They don't care about that. They care about their shareholders. They care about profits. That's the way it goes. Central bankers won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. And that is so important. Let's look at that. Inflation has peaked, but it's not returning to let's say 2019 levels in 2023. That's according to MasterCard. Because if you look at what's going on with inflation, yes, it is going to fall from what they say their statistics, the CPI and so on. In fact, by the time you're watching this video, the CPI data may be released. And if it's different than what we saw with the wholesale data, then it could show that there's a continuation of this decline that is experienced. That's important because, of course, investors and Main Street is going to look at this information and say, okay, is stuff more expensive? Is stuff getting cheaper? How am I able to deal with my current level of disposable income and the debt that I'm trying to manage? Because everybody's in debt today, whether it's a MasterCard or whether it's a Visa or whether it's any form of debt like a house. Everybody has some form of debt, or the majority of people do. The question is it able to be paid back? And for a lot of people, that's not possible as the Federal Reserve increases interest rates. So the belief is they're just going to turn around, and that brings me to this. The Federal Reserve is about to hike interest rates one last time this year. As you watch this video, it may already be out, and you'll see the Federal Reserve's information that they're going to hike 50 basis points. Anything other than 50 would be a shocker. But it tells you that when you have debt, when you are borrowing, you're going to pay a much higher price, especially long term. I think about if you're borrowing $500,000 and you're on a variable, and you might think, I'm not on a variable, but trust me, a lot of people around the world are on variable. If you're using a variable mortgage or you're on a credit card and it's 19% at this point and those rates keep going up, you got to think for yourself, what that does to the overall cost. You bought something worth, let's say $500,000 with that mortgage, or you bought something that's $10,000 or $500, whatever the case may be. Now you add on top that interest, suddenly that purchase is much, much larger. Yeah, that's great for the economy when you're talking about MasterCard stock and you're looking at all these other things that don't pertain to you necessarily, but it doesn't help you. When you got to pay more interest, it doesn't help you. Double Lines Gundlach says 2023 will be a recessionary year with the Fed starting to cut rates. And that's where things get interesting. Because if they cut rates, stocks are going to love it. Not all stocks, but certainly some of them. After months of steep hikes in interest rates, the Fed is facing a surprising reality. The damage to financial markets and the broader economy has been relatively modest, and inflation is showing signs of easing. Bubbles in both the stock market and home prices are shrinking from their historic surge, but only gradually. This basically gets into how we're talking about cryptocurrencies and everything else that's led up to this point. Well, Powell and other Fed policymakers are meeting to raise borrowing costs again in a fight against the highest inflation in 4 decades, but they're not close to winning. The case here is that they will need to increase rates to about 5% or so on the Fed funds rate. Imagine what a mortgage rate would look like if that's the case. And then they're going to keep them there, so they say, for a long period of time until inflation gets back down to their target, which is 2%. This would be, I would consider it somewhat devastating to everything involved. And let me break that down for you here. Let me explain what this really means. When the Federal Reserve lowers interest rates, the US dollar tends to weaken. This reduces the value of the dollar relative to other currencies, making imports more expensive and exports more competitive. A weaker dollar can also make foreign investment less attractive, leading to a decrease in foreign capital coming into the US. Historically, the Federal Reserve has lowered interest rates in the face of economic downturns. In 2008, the Fed slashed interest rates to near zero levels in response to the Great Recession. This helped stimulate the economy, but also weaken the dollar and put pressure on exports. The stock market can also be affected by a drop in interest rates. Lower rates can make stocks more attractive as investors look for higher returns. Historically, the stock market has responded positively to a decrease in interest rates. However, a prolonged period of low rates can lead to overvaluation and could potentially cause a stock market bubble. Famous economist John Maynard Keynes famously said, quote, "The boom, not the slump, is the right time for austerity at the Treasury," or the Fed. This quote is a reminder that dropping interest rates can have negative consequences and should not be done lightly. That's where we are at. This is the breakdown. This is the understanding of where we have to be here in the near future. For a lot of people, they don't get it. But this is what you, the individual, has to deal with. How much money Americans say they need to make to feel rich. And basically what it showed in this survey was that people need to make $200,000 in order to feel rich. The majority of people anyway. So that would be quite a significant sum when you look at it compared to the average. But understand, house prices right now, extreme. You're going to be buying a home, a lot of places, $1 million, maybe $750,000. Depends on where you live. And add on top of that, the mortgage rate. Okay, so we got borrowing costs. What about renovations? They're not cheap, let me tell you. You look at cars, they had gone up in price. You look at energy and so on. So 200,000 ain't what it used to be. So that's what people deal with today. Half-price Tesla stock is still no bargain. So you can look at it in the individual level, and the point I'm trying to make here is suddenly something changed. 2019 into 2020, this particular stock went parabolic. And suddenly they believe that everything, okay, yeah, robo-taxis, 1 million robo-taxis, we're going to have all the Mars, the Teslas are going to be on Mars tomorrow. And that was the justification for the stock multiplying. And Elon Musk himself said on many occasions, the stock is too high in my honest opinion, and the stock just kept going up and up. He literally said it multiple times. And so which one is the correct valuation? Well, just like any asset, it's whatever somebody else is willing to pay. There's always a buyer and a seller in the transaction. And that's where we are at today. Some very confusing times because of all the easy money. Easy money changes, and suddenly something that was valued so high before is no longer at those levels. Robots set sights on a new job, sewing blue jeans. I thought this was funny, but basically what they said was This is challenging actually to do textiles for robots because each material is slightly thicker or thinner, and then polyester is going to respond different than cotton and all these different things. But they're working on it. So we've got robots coming. Robots are coming to take the jobs. We know that. It is absolutely a fact. All these companies are investing in some level of robots, whether it's Chippy, the robot at Chipotle. That's a real thing, by the way. Flippy, the robot at White Castle and other places. They are actively spending money to replace humans that are saying, we don't want to work anymore, or we're not willing to work at the rate you're paying us. And the companies are just saying, you know what? That's fine. We're just going to replace you. So we have to figure out what we're going to do in this new world. Now, I'm going to break down that whole new world aspect to you in a moment. But I wanted to show you this. You remember what I was saying to you about the US going out and saying, don't sell your stuff, don't sell your semiconductors to China. We don't want them to deal with Chinese businesses. This is for national security. Well, it takes a step further right now because Japan set to join the US in tightening China chip exports. Japan and the Netherlands have agreed in principle, by the way, to join the US in tightening controls over the export of advanced chip-making machinery to China. That, my friends, I wish I was seeing more information about this because of how serious it really is. China's trying to fight back on their end, but at the same time, we're seeing this. India and Vietnam could benefit as chip makers shipped away from China. Yes, absolutely, I do agree. I had brought to you in a previous video about this, and it's going to take a long time. The suggestion based on a report was it's going to take 8 years for Apple to move 10% of their manufacturing and assembly outside of China. I mean, it's just like India is just not there, and Vietnam certainly isn't either, but they're going to do it, okay? Because the diversification is what these companies want. They don't want to have the same problem again that we had in 2020, that's for sure. These two countries, though, look carefully because they could be in a good position. Okay, at least they're gonna see more income. They're gonna see more building. They're gonna see more happening, and that is, of course, positive for their economies. China props up Belt and Road borrowers via unusual channel. You see, they've got issues too. China has issues, and of course, their partners that they're dealing with, they're expanding. They're doing infrastructure all over the place, and you can see this article here pointing out one important fact. People's Bank of China uses currency swap lines to support governments that borrowed heavily from Chinese banks. Some say that this is all part of the grand plan. You put them in debt, like sort of what the IMF does, and then you can have control over their infrastructure. I don't know specifically. I'm sure each case is different, but I just wanted to show you that there's certainly a lot of turbulence that's going on right now. We have this basically about the reopening of China, and I wanted to highlight it because investors today are looking for their in on China. We got to invest in Alibaba, we got to invest in Tencent. It's always, of course, the tech stocks, but this is something that investors are really waiting for, and some of them have already gone in. Of course, we're off the bottoms, but they're waiting for the reopening, and you can read many different reports. They're reopening. Okay, if that's the case and it stays that way, and we don't just revert back, then it is very positive for these Chinese stocks. Of course, there's a lot of rules and regulations that have been going in for Alibaba was feeling it, Tencent was feeling it, and they got hit hard. Their stocks are down considerably from the highs. So even if you don't have to pick the bottom, this regardless would be positive. Flood of Russian crude heads to Asia after EU ban kicks in. Almost 90% of Russian seaborne crude headed to Asia in the week to December 9th. The reason I mention this is because you're looking at the sanctions, you're looking at the actions from the United States and the West against a country like Russia. Russia's basically saying, look, we can't do business over here, so we got to do business over here. And they're doing this with China. They're in lockstep with them, and other countries, the BRICS nations, are basically saying, we literally can't do business on their platforms, on their infrastructure. So to survive, we got to move in this other direction. I understand what they're doing. So let me break it down for you. Let me really dive deep for a moment. One reason why countries like China and Russia are trying to reduce their reliance on the US dollar is because of its volatility over the past few years and the global economic uncertainty. By building their own infrastructure and financial systems, they can be more independent and mitigate the risks associated with relying on the US dollar. Furthermore, they can better control their own currency and monetary policy and be less susceptible to global economic forces. Additionally, they can reduce their reliance on the US dominated global financial system, which has been known to be exploitive and in certain areas such as trade and finance. Finally, they can also increase their influence and power on the global stage by having their own currency and financial system that is not as closely tied to the US. They are doing all these things now with China at the forefront, and this is important because you have a crisis, you have a problem, and then you feel it in Main Street. Too much inflation, all these issues that are piling up. And then you've got a change, a big change, and that is what was once super low interest rates, then moderate interest rates, and the potential, the suggestion that they're going to cut interest rates. Quantitative easing moves to quantitative tightening. When the central bank makes these decisions, you got to understand that that has a direct impact on you. You feel it in Main Street. That's the way this works. Inflation can be out of control if the Federal Reserve does not get it down. How do they get it down? They got to leave interest rates higher for longer than what people want, and you got to hear a lot of complaints before it will stamp that down. Previous video to this one, I broke that all down about the 1970s and so on. If you haven't seen it, definitely check that out. But listen, let me ask you something. Did you find this video informative? If you did, what I ask is that you hit that subscribe button, because in each video, every single day, I break down the information you need to know. In the next video, I'm going to talk about the Federal Reserve and their actions, what has happened. I'll give you the entire breakdown. Hit subscribe. I'll see you tomorrow.